America doesn't need Canada, or so it thinks. There's a quiet financial shock happening right now, not on the news, not in headlines, but deep inside trade data, energy flows, and balance sheets. The United States is slowly acting like it doesn't need Canada anymore. No announcement, no press conference, just numbers. Billions in trade shifts, energy contracts quietly renegotiated, supply chains being rerouted. And here's why this matters to you. Because when major economies start believing they can go it alone, prices change, jobs move, currencies shift, and portfolios feel it. Your cost of living, your investments, your job security. So why is this happening now? And what does it mean for your money going forward? Stay with me. We'll break this down simply, clearly, and without panic. Why Canada ever mattered to America? For decades, Canada wasn't just a neighbor to the US, it was a financial extension. America's largest trading partner, a top supplier of oil, gas, electricity, lumber, uranium, a stabilizing force in US supply chains when Americans filled their gas tanks, when homes were built, when factories ran. Canada was quietly in the background. And here's the key detail most people miss. This relationship wasn't emotional, it was efficient. Short distances, stable politics, reliable pricing. So the question isn't whether Canada mattered. The question is, why would America start behaving like it doesn't anymore? The answer unfolds slowly and financially. First, origins. The illusion of independence. The shift didn't start with politics. It started with technology and numbers. US shale oil production exploded, domestic energy output surged, America began exporting energy instead of importing it suddenly. Balance sheets changed. On paper, the US looked more self-sufficient, and markets love self-sufficiency. But here's the illusion. Producing something isn't the same as replacing a stable partner. Canada wasn't just energy, it was predictability. And predictability is priceless in finance. Second, escalation. When cost-cutting meets confidence, as confidence grew, so did risk-taking. Companies diversified, suppliers away from Canada, energy firms chased higher margin exports, trade became more transactional, less relational, short-term profits improved. But long-term exposure increased. This is a classic financial mistake, optimizing for efficiency while ignoring fragility. The same thing happens when households rely on one income stream, over-leverage during good times, assume stability will last forever. Markets reward confidence until they punish it. Thread breaking point. Stress reveals the cracks, then pressure hit. Global inflation surged, interest rates jumped, supply chains tightened, energy prices spiked. And suddenly, the "we don't need Canada" mindset faced reality. Replacing a nearby, stable supplier with longer routes, higher insurance, political risk meant higher costs. Not immediately, but gradually, quietly, and permanently. These costs don't show up as headlines. They show up as higher utility bills, more expensive homes, volatile stock prices. This is how macro decisions hit micro wallets. For fallout, the hidden personal finance impact. Let's make this personal. When trade efficiency drops, inflation sticks around longer, central banks keep rates higher, mortgages stay expensive, businesses slow hiring. Even if you never think about Canada, your rent, loan payments, retirement account feel the ripple. This isn't about countries, it's about cost structures. And cost structures always land on consumers. 5 failed fixes. Why simple solutions don't work. The usual fixes get mentioned. Just produce more at home. Just find new suppliers. Just wait it out. But finance doesn't work on slogans. Domestic production often costs more. New suppliers at risk. Waiting increases debt exposure. It's like a household saying, "I'll replace stable income with side hustles permanently." Sometimes it works. Often it doesn't. The market hates uncertainty more than cost. Modern parallels. Where you're seeing this today, you're already living this story. Higher interest rates lasting longer than expected, energy volatility impacting transportation and food, housing shortages tied to material costs. Stock market swings driven by global trade assumptions, and notice the pattern. Whenever systems assume independence, they lose resilience. The same applies to personal finance. One job, one asset, one strategy works until it doesn't. Takeaways: practical lessons. Lesson 1. Stability is an asset. Reliable systems, whether countries or incomes, reduce risk. Don't underestimate boring, steady sources of value. Lesson 2. Diversification isn't optional. Nations diversify trade. You should diversify income, investments, and skills. Lesson 3. Watch structure, not headlines. Markets move on infrastructure and flows, not speeches. Follow energy, debt, and supply chains. They predict inflation and rates. And here's the uncomfortable question. If major economies can misjudge dependency, what assumptions are you making about your own financial safety? The real meaning of America doesn't need Canada. America doesn't need Canada until it does. And that's the real lesson. Financial systems don't break loudly. They weaken quietly, through small cost increases, through longer timelines, through invisible dependencies. Those who understand this early protect their money better. Because awareness isn't fear, it's preparation. If you want to understand global financial shifts before they hit your wallet, subscribe to the channel. Like the video if this helped clarify the bigger picture. And comment below. Where do you see hidden dependencies in today's economy? Because the smartest investors don't react late. They see early.